Thanks everyone for coming. We are doing a new live episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
So as Tracy mentioned before, we are here interviewing Brad Jacobs, Chairman and CEO of the newish firm QXO, which is going to make a major splash in the building material space. Brad, thank you so much for joining us.
Slight correction. We've already made a splash.
You've already made the splash,
yes,
have you?
Yes.
What have you done? I see you've raised a ton of money. Is that counted as a splash?
So since first of all, thank you for inviting me.
Okay.
Thank you for coming. But since we did that podcast,
we talked to Brad, I think in December.
Seems like a long time ago.
Yeah.
We built out the management team.
Okay.
So I have 15 amazing people now, one of whom was the head of M&A at Barclays. He's on garden leave. And all the rest I know really well because they either worked at XPO or GXO.
Some company with XO in it.
Yeah, it didn't have X and O in it other than Exxon. We didn't hire them. And then also we raised money. We put our $1 billion into the PIPE that we did into that public company.
Yep.
And then we raised another $3.5 billion from institutional investors, mostly long-only funds who know us. And now we're out there. Going to next stage is let's go buy some companies.
Wait, so $4.5 billion raised must be the biggest single raise in the building industry's history, right?
Yeah.
So what's the pitch when you're going out to people and saying, give us your money for this as yet unproven business model? I know you have a number of companies, all three-letter acronyms, but why do they want to give you $4.5 billion? Or 3.5.
Okay, here's the secret. I know most of the people who invest in us. It was mostly people who've invested in one of the XOs or United Rentals, United Waste, the historical investors who did well, and they're betting that we're going to do well again.
So when you're talking to investors who already know you, what do they think is the Brad Jacobs playbook for creating companies?
Well, as you know, I actually have a book with the playbook in there.
Oh, yeah. Brad's book has also a very modest title, which is How to Make a Few $1 Billion.
I think that's a good title, catchy title. It gets people to remember. So the playbook is pretty straightforward. It's, first of all, talent, making sure the people in the company are amazing, are honest, or hardworking, or collaborative, or really special people, that they can get along with each other, and we figure out ways where we can debate issues honestly and disagree with each other without being a jerk, being still nice and respectful, but honestly debate so we can get to the right decisions. It's moving fast, being decisive, and it's an M&A play, which means we look at many, many acquisitions at the same time, so we don't fall in love with one of them and overpay. That's the cardinal sin in M&A, is overpaying. That's the IC in ROIC. And then integrating those businesses very thoroughly. So we have one company, one brand that has a power in the marketplace.
Okay, so one of the things we learned the last time we talked to you, I think you said across the US and Europe, building products, $800 billion industry, at least it was back then, maybe it's higher now. We know there's a lot of building going on. There's housing, there's infrastructure, there's all the green stuff, there's data centers, et cetera. We learned it's extremely fragmented, this market. There's no one big giant in the space. With $3.5 billion or $4.5 billion, are you going to start with some big deal that's a big chunk of that, or do you see that going to a range of companies that you'll then consolidate?
Stay tuned. I'll give you the scoop when we get one.
Give us a little, come on.
So we're not looking at tiny little companies. We're going to build a $50 billion company, $50+ billion company over the next decade. So, we're going to have to chop some big wood here. So we're looking at more larger acquisitions.
But more than one, do you see more than one?
We're going to do more than one acquisition over in the coming years. We're going to be acquisitive. So it'll go start and integrate.
Yeah.
M&A and then integrate. M&A, integrate. And after we integrate, we pay attention to a bunch of metrics like customer satisfaction, employee engagement, on-time performance, and so forth. And if it's humming, we're closing the books on time, get clean numbers, everyone is in good shape. Then we go back and rinse, wash, repeat, and go buy something else.
Okay, I remember every Sunday when I was growing up, my parents used to give me $10 for my allowance. It was actually 1,000 yen, but back then, I grew up in Japan. Back then, it was about $10, and that will always be the exchange rate in my mind. But I would get my allowance on Sunday, and I would go out and I would buy the first thing that I saw. You've got $4.5 billion. Do you feel a sense of urgency to spend it?
So we feel a sense of urgency in life in general. We feel that time goes by fast, and if you want to make your mark, do something big, let's do some stuff. So we're prone to action. The fact that we've got $4.5 billion and we've got leverage we could add on to that, that's completely irrelevant. That doesn't put more pressure on us to do a deal. What we have pressure on us is to do good deals, accretive deals, strategically compelling deals, deals that make sense to do, deals that we can grow them over 5 or 10 years and they'll be much bigger businesses at that time.
Let me ask the question in a slightly different way. Before you announced QXO, did you have a potential list of targets in your mind? Is that how it works?
So fast rewind. So a year and a half ago or so, I stepped down as being CEO. I'm still chairman, executive chairman of XPO, but I stepped down as the day-to-day running. Mario Harek is doing that, doing a fantastic job. And I looked at 55 different industries to see which one does my playbook fit that we can create some shareholder value with. And I hired 2 consultants who have expertise in this, consulting firms. And part of the mission was to educate us about the business fast. Part of the mission was give us a list of who would we buy? Give us a 1 or 2 pager on. So we put together about 1,000 names to look at. And Matt Fassler and Austin Landau worked with me very closely on that project. And then we pared it down. We filtered it to about 40 names that have about $300 billion in aggregate revenue. And then we pared it down even more to the top dozen, and those are the ones that we're really focusing on.
Let's talk about building products. So, and there's a lot there, and this is a wide-ranging space. One of the things that we talked about on the last time we talked to you, and one of the things that Tracy and I have learned over the last several years, we've done a lot of logistics and supply chain related episodes, which is that much of this space, the physical world, ordering a bunch of lumber, ordering HVAC equipment, whatever, it does not feel like 2024, and there's a lot of old tech. And
I like that.
And so it still seems like there's an opportunity.
Yeah.
You talked about this already, that there is an opportunity to upgrade the tech. So here's what I want to ask. If I go, or let's say I'm a contractor and I need to buy some equipment, some bricks or something like that, what is the experience like today? And what is the experience going to be like after you've applied your secret sauce?
Okay, so a ton of stuff in there. So first of all, the long-term growth and demand.
Yeah.
So the residential, let's start with there.
Okay.
Residential construction is unconstructed. There's millions of units we're short on, and I live in Greenwich and Connecticut, and I have friends who want to move from Manhattan, and they're having a real tough time finding a property to buy. It's very, very tight. That's not a Greenwich phenomenon. It's a countrywide phenomenon. Absolutely. It's a phenomenon in Europe, too. We've underbuilt, and now, so that's going to be growth. There's going to be growth. And there's old. So most houses in America are the average house is 40-something years old.
Yeah.
Which is old. I mean, when I was a kid, 10 years old was like an old house. If someone was living in a 15, 20 years old, is your father having a bad time? What's going on? So this is old. So this is going to be repair and remodeling, and there will be new construction. Commercial's the same thing. Commercial's actually older. Commercial's 50 years old is a typical commercial building. And then you got the infrastructure building, all the roads and the bridges and the tunnels. Trillions are going to have to be spent on that. So I think if you fast forward 10 years from now, high likelihood there's going to be more demand for building products than there is today. I think so one of the things I filtered for when I looked at those 55 industries was, is this an industry that's going to get disrupted by AI or another form of tech or automation? And I think it's a safe bet that 10 years from now, we'll still have some form of physical body, and we'll sleep in a physical house with a physical roof and physical windows and physical doors. And so I think there'll be more demand as a result of all that.
But just to follow up, what's the buying experience right now?
The buying experience is not
great. So what happens? Someone goes to a warehouse. How does that work? I imagine there's pen, paper, faxes, email.
Yeah, you got it perfectly right.
And then what's it gonna look like when that same person goes to the same distribution center, aka warehouse, and is after it's QXOified?
Yeah. So right now, when you talk to customers and you say, what do you think? They generally think the industry gets about a 6 out of 10.
Okay.
You say, rate the industry 1 out of 10 in terms of your customer experience. How delighted are you? 10 meaning delighted, 1 being it's a stinker. It's about a 6. That's what I generally hear from people. And the two main reasons why people only give it so in the follow-up question, what would make it a 10?
Yeah.
The two main things that you hear are, I ordered 10 things, I needed the 10 things, and I got 6. And I got back ordered on the other 4. And the other complaint they have is, I'm in a project, and I ordered it, I needed it by a week from Tuesday, and I got it like a week late. And that cost me money. So it's very frustrating to customers to not, now why is this happening? It goes to your other question. Technology. Absence of technology. So one of the companies that we spun off that I still chair is called GXO. It's the largest pure play warehouse company in the world. It's got over 200 million square feet of warehouses. It's got 1,000 warehouses in a couple dozen countries. If you go to a GXO warehouse, you're likely to see collaborative robots, likely to see robotic arms, autonomous equipment. You'll see a very sophisticated WMS, a warehouse management software system that keeps track of every single SKU in the warehouse and does inventory on a daily basis. So you know everything that's in the warehouse. And one of the benefits of that is that you can do demand forecasting, and then you can do inventory management. So you get just the right amount of SKU, not too much, and then you're killing working capital. Not too little, you're annoying customers because you're not stocked up right. So I think if we use tech to do proper 2024 inventory management, I think we can delight customers. And I think that'll differentiate us in the eyes of customers.
I'm going to ask the obvious question then, but we're talking about inventory management, making the company more efficient. Why don't existing building distribution companies already do this?
There's about a half a dozen who actually are. So Ferguson gets the joke, and they're doing that. Watsco understands this, is doing that. Builders First Source seems to be doing a good job doing that too. And a few other companies are too. But by and large, the industry, I have a theory to answer your question. It's not proven, this is my hypothesis. My hypothesis is this is an industry where you get about roughly 75%-ish conversion from EBITDA to free cash flow. So there's not a lot of CapEx. There's working capital, there's not a lot of CapEx. So it spits off a lot of cash. So in a downturn, there's not a lot of bankruptcies. So if you're in the trucking business, or if you're in the garbage business, you're in a construction, you have high fixed costs, you have inventory. When you have a downturn, you see people who messed up and they took on too much leverage, they can't pay their debt, they can't service it, boom, they're out. You see people who have inventory and they can't get rid of it fast enough, so they have to sell it at distressed prices, it kills them. You don't see that here. So in this industry, you don't have the Lean Six Sigma, continuous improvement, Kaizen mindset of every day I got to find some sofas to turn over and shake and find some nickels and some pennies and some dimes. That's not the mentality. So I think we'll bring that operational rigor, that focus on operational excellence. I think we'll bring that to the industry. There are some companies doing a good job. Don't misunderstand me. I'm not casting the whole industry as doing a lousy job. But I think in general, particularly the smaller ones, they could improve.
Is that a matter of balance sheet capacity? You're bringing a lot of balance sheet capacity. As such, you have the maybe luxury to invest across the cycle. Is that basically the gist here?
It's a couple of things. One is having the size to be able to afford that.
Yeah.
And we're going to invest hundreds and hundreds of millions of dollars into technology. If you're only doing hundreds of millions of dollars in revenue, you're not going to put hundreds of millions of dollars into tech. But we need to do that. That's what's going to differentiate us from the have-nots. That's the main thing there. The second thing is it's a mindset of what I was talking about before. The industry as a whole has not had this passionate, intense commitment to continuously improve the business and to delight customers more and more and more and more. It's not, that passion's not there. In general, some companies have it, but in general, the industry doesn't have it.
So Joe and Brad and maybe some Odd Lots listeners know that my husband and I are currently building a shed in Connecticut. And when I say shed, it's actually, in New York, it would probably be the size of a small house. But because we're doing this and we're doing it by hand, I now feel empowered as a construction expert. So I can ask Brad all these questions. But you mentioned the frustration of getting supplies and having to wait ages for,
Did you have to wait?
Yes.
Did you get your order delivered in full or just in part?
In part.
There you go.
But okay.
There you go.
But I take the point about efficiency and reducing lead times and things like that. How does technology aid with quality control? Because I'm sure this is the other big thing for anyone who's ever done construction work. You order a piece of plywood, you think that waterproof, I'm getting very specific here, you think that waterproof coating is going to be on the wood, and then maybe it's not as good as you thought it was.
That's two things. It's tech. The system should be able to track that, and there should be controls on that. And secondly, it's a cultural thing of caring. So I mentioned before that we do M&A, and then we stop and we measure a bunch of things. And one of the things we measure that I mentioned was employee engagement. You want very high levels of employee morale. You want employees to care, to really, really care about the customer. And you want to hire people who have that customer-pleasing mentality. And as I was saying before, I think the industry could use a little more on that.
You do one of these XO companies like every 10 years, and you've done several. I'm guessing this is the first one that's, or I don't know if it's the first one actually, but for the first time in a long time, there's a high cost of capital, interest rates are where they are, they may not come down anytime soon. What is the difference today in looking at or evaluating deals in 2024 versus whatever you were buying in 2014?
So let's talk
what effect does that have?
It's an important point. Let's talk about cost of capital.
Okay.
Debt is higher than it was for the last 10 years because it was almost free.
Yeah.
So definitely is a cost to debt. But we're not going to be highly levered. We're going to lever this business something around 1 to 2 times is our standing target. Sometimes we might go over for a short period of time in connection with an acquisition, but our target is to keep it at 1 to 2 times. Equity is not more expensive. I mean, markets are all-time high.
Yeah, that's right.
Equity is okay. Equity is okay.
But just on the, what about when it comes to the buying the company part? Does the math change at all in this environment? Does it affect sellers? Do they say, oh, I want to wait for rates to come down and multiples to go up, or et cetera? Like, how does this current environment affect that process?
It's a dynamic market, and you have a whole range of people. You have some people saying, I think it's going to get better over the next couple of years, and interest rates are going to come down, and I'm not selling now unless you pay some really crazy high price. You have other people who say, you know what, kind of feels soft out there. Some of the public companies have been missing their numbers recently, and some of the indicators coming out, looks like construction might be softening, the industry might be slowing in general, and the economy might be slowing possibly over the rest of the year, so they want to sell now. So it's a range, it's a whole range.
Wait, tell us more about this, because of course everyone looks at construction as a leading indicator for the economy.
It's not the most leading. Transportation is more leading.
Oh wait, okay, talk about that too.
You definitely have a view on the economy with all the boards.
You're talking to a bunch of different
Tell us
companies.
what's happening right now.
Okay, there are 2 categories of professionals who traditionally have fairly consistently been wrong about predicting the economy. Actually, 3.
Is one of them podcasters?
Economists, the Fed, and CEOs. So I was at
You spared journalists, so thank you.
Journalists haven't been bad, actually. Because journalists are providing both sides.
Okay.
They don't really take a view and say, on the one hand, it could do this, on the other hand, it could do like that. So I was at a CEO trade association thing a couple years ago, and you have these little Slido apps where you can vote in the audience. People get their phones out and they vote. You should never do that because they never come back to what you're doing. And once they're on their phones. But we take a vote, and the vote was, what's the likelihood of a severe recession, a moderate recession, no recession, growth, da-da-da. Over 90% of these, smart, quote-unquote, CEOs said there was either going to be a severe recession or a moderate recession. Well, there's no recession. So it's hard to predict this stuff. And right now, it's much harder than it has been in the past. And I say that because you have these 2 opposite things going on. You still have a bunch of stimulus, which is inflationary by definition, and you have interest rates having gone up, which is like the brakes and slowing things down. So the economy is like really weird. It grows, but then it contracts. And there's a tension there. So I don't know who's going to win the arm wrestle here. So I don't know the answer is the honest answer. I don't have a firm view with strong conviction like the rest of the year is going to be strong or weak.
Well, since I mentioned conversations with other companies, here's something I always wanted to ask a serial roll-upper, if you will, or a serial M&A person. Warren Buffett is still on my list to ask this question, but maybe one day.
Just call him.
Yeah, maybe I will.
He takes calls.
When you approach a company, how do you actually do it? What's that initial contact like?
Very straightforward. So
you send it a DM on X/Twitter.
I usually call somebody. I just call them up and say, hey, I'm Brad Jacobs. If you haven't heard of me, I'm trying to do some acquisitions and learn.
Have a book to sell.
There you go. get $3 every time you buy. And you know, I could have an interest in buying your company. I don't know yet. I got to learn more, but I could have an interest in, you know, the reaction usually is one of two things. It's like, look, I'm happy to meet you. Could be an interesting guy, but we're not selling the company. That's like sometimes true and sometimes baloney. And other times people say, hey, you know, at the right price, why not? Come on over. I find a different reaction depending on who the seller is. So there's a spectrum of types of folks. The private family companies are great because I call them up and they say, yeah, come on over. And it usually turns into like a 3-day event. We're just hanging out, meeting the people, touring the facilities. And I really understand the business. And I appreciate that. And I reciprocate for that because that's really great. On the other end of the spectrum would be private equity owned ones where it's very controlled and very choreographed. And you have to really keep your antennas up to figure out what's true and what's not true and what are the real numbers and so forth. And in between that, I would put corporate companies. We've done very well with the carve-outs, corporate carve-outs. That works well. We're looking at some in this industry as well. But even buying whole public companies has worked out well for us too. We just announced one with RXO a couple of days. Well, actually, it wasn't a public company. It's a division of a public company. It's a carve-out.
There was Coyote from UPS.
Coyote, yeah.
Right. And the investors really liked that deal.
Up 20-something%.
You mentioned distribution for commercial real estate earlier, and I'm curious, are there additional considerations for commercial versus something like residential or infrastructure? And one of the reasons I ask is because we were speaking with, I think it was the CEO of Tractor Supply, Hal Lawton, and he was talking about how expensive it is to build out these big stores nowadays. And he was talking about ways to save money in that space. And I think I jokingly said to him, like, well, you know, you run a distribution company, essentially. You bring goods into the store and then you sell them. Couldn't you become your own supplier and distributor for construction materials? And he was like, yeah, that's something we're looking at. Would you expect to see more big commercial companies like a Walmart, for instance, or a Tractor Supply, start to be their own suppliers and distributors for construction materials? They have the scale already.
Yeah. Both those are good customers of the XPO family. So I like both those.
I think
names.
the Waltons are invested in the new company as well, right?
No comment. That was Bloomberg speculation, but that wasn't from us. So I think you already, I mean, sometimes it's not through distributors. Sometimes if you have these big purchasers, they go direct.
Yeah.
They go right direct, and that's fine. That's like in most industries. The ones that have the massive size, massive procurement, they tend to go direct. But that's an exception, not the rule. That's a few at the top.
Question from the audience that's good. By the way, I think there's a way to, Tracy mentioned there's the QR code if you want to enter in a question. There is others, as you mentioned, there's others in the space, in the buildings products industry. Others are trying and presumably seeing the same thing of consolidating this hyper-fragmented space. How do you think about competition for deals, and how do you balance that competition while not avoiding the winner's curse or overpaying for companies?
We don't overpay. We don't underpay. We don't try to steal a company or take advantage of anything like that. We pay a fair price.
Okay.
Fair price. We don't pay these trophy prices. So sometimes you see in many industries, companies, they're not really professional M&A machines. They're once in a while do a big deal.
Yeah.
And they overpay. And when you overpay, it takes years and years and years to get your cost of, it doesn't work. In terms of creating shareholder value.
Yeah.
If your focus is on shareholder value creation, then you need to pay a reasonable price in order to get good returns on that. Competition for M&A is normal. I mean, in every industry I've been in, I haven't had a monopoly on being a consolidator.
Yeah.
I'm going to ask a very cliched question, but I think it might be illuminating in the sense of what you look for in an acquisition. But is there a particular deal that you're most proud of?
Well, you know, it's like asking who's your favorite kid. Like you can't answer. I still get Christmas cards from like most of the people I bought. So there are. I would say 2 deals. It's hard to pick which ones. So in 2015 at XPO, we did 2 deals. We did Conway, which got us into LTL, and now we're an LTL behemoth. And the other one was Norbert Dentressangle, which was a French company that did contract logistics and trucking and brokerage and LTL, and different parts of that company we put with the different spins. And both of those were really good. And both of those were really good because they gave us scale and they gave us an opportunity to apply our playbook to those businesses and dramatically improve the profitability and the return on capital on both of them. So from a point of view of shareholder value creation, those were very remarkable deals. So I would pick those two.
Why don't you tell us more about that Conway deal? So less than truckload, carrier. When you say we applied our playbook, because that's what we're trying to understand further, what did you do? Conway came into the house, and what did you do with it?
First thing we did is we looked at the organization chart.
Okay.
And figured out, and when you have an organization chart, I've looked at a lot of organization charts, it should be real elegant. It should be simple and geometric and just really, really simple and straightforward. Their organization chart was spaghetti thrown at a painting. There's some artists who you look at the painting and say, I don't know, it kind of looks like he just took a bunch of mud, put it in paint, threw it on the canvas. That's what their org chart looked like. It was very unsatisfying to look at it. And there is a correlation between the beauty of it, elegance of it, and the effectiveness of it. It's a very, very interesting concept. Theirs wasn't. And they had multiple, it was a business that had grown up Kluge style, K-L-U-G-E, meaning they bought some stuff and they never really integrated it thoroughly. To do integration, you need courage. You need confidence. You need to know that what you're doing is the right thing and execute on it. They were more sheepish about that. So they had 3 IT organizations. They had 3 HR organizations. They had 3 finance accounting organizations. They had 3 of everything. And you don't need 3 of everything. That's 2 extra than you really need. So we went in there and we did an exercise that we do all the time as part of continuous improvement, which is look at everything that we're spending and look at everyone who's on the payroll and think, how are they contributing to achieving our goals? And are they must-have costs, must-have people? Or are they kind of nice to have, but it's not really critical? Or are they like, how the heck did this get in an organization? You find a lot of that kind of stuff, particularly in bigger companies where things just kind of grew and no one got rid of it. But it served its purpose and it's not doing much more. So we went through the whole organization and made it streamlined and more effective. And then in the last few years, we got our service levels up really, really high. And as a result of that, we were able to get yield growth and we were able to take market share as a result of that.
Good question from the audience. They ask, what's the biggest challenge of breaking into the building products supply chain? I guess another way of asking that is, what's stopping you from making $1 billion of revenue right now as opposed to the end of the year?
Give me a little time. We've been in the business 10 seconds, but we'll get there. I'll satisfy you on that goal. So the biggest obstacle to achieving big goals, personally too, by the way, personally and professionally, are people. The people that you associate with, the people you surround yourself with, people you deal with all day long, the people whose exhales you inhale and vice versa. That's the key thing. If you can get fantastic people, smart, honest, hardworking people who get along with each other and get the right culture of how you interact with each other, you can accomplish enormous things. You can dream big and actually achieve it. If you don't have that, and you have to have it universally. You can't just have, your top 25 people, you can't have 15 are hardworking, but 10, maybe they work, maybe they don't work. You can have 15 honest ones and 10 are dishonest. It has to be all, in this example, 25 out of 25, 100%. If you can concentrate on the quality of the people and the rules of engagement between that constellation of people, you can move mountains.
I think there might be someone in the audience who also is planning a roll-up because they want to know what was your number 2? What almost made the cut? The 50 industries you looked at. What didn't happen, and so therefore there's an opportunity for someone else?
So my absolute favorite one, apart from this, was oil and gas. So E&P oil and gas. So I used to be in the oil business a long time ago. And right now, you can go out and you can buy producing properties for 3 times cash flow. Wow. And then you have an annuity for 15 years of just getting. And
that's right today. These prices,
right this
exist.
Right this minute. However, you can't finance it. You just can't finance it. I went to 17 sovereign wealth funds and long-only funds that have historically financed XPO in the past and went over the things I was looking at. I said, what do you think of energy? Every single one said, no, Brad, don't do energy. We can't do that. It's ESG, or they got burnt during the boom, or for whatever reason, it was just they're sellers, not buyers. Well, that makes low prices when there's not a lot of buyers and a bunch of. Now, similar phenomenon you see in Europe, sort of. I mean, the analogy breaks down at a certain point, but in Europe right now, in building products distribution, very few buyers. Very few buyers. Yeah, I can't think of one big strategic that's doing a roll-up in Europe. And the private equity firms is just a handful of them, whereas here in the United States, there's a couple dozen of them who are active.
Would you ever do renewables? I mean, since you
what?
brought
Sorry?
renewables, since you brought up the financing point, I mean, I don't think
Kind of
people.
the exact opposite.
Yeah, I don't think people are falling over themselves to finance renewables necessarily, but you don't necessarily have the mandate constrictions. Is that something you see any value in?
I think green, renewable, this is all sustainability. These are long-term real trends. This is the future. It's not just a story. And I think any company that wants to succeed and prosper needs to be thinking about, am I leaving the world in a better place? So I think every company, not just our company, not just our industry, needs to be thinking about all those things.
Another question about global supply chains. And obviously we hear a lot about friendshoring or companies feeling that they have to reduce their exposure to China because reasons or whatever. How is that going? How are those trends going to play out within the context of building supplies? What are you seeing in terms of geopolitical risk hedging, maybe is the way to put it, and the sort of changing geography of supply chains within building supplies?
Well, China is certainly a risk because the relationship between China and the West is probably an all-time low. So it's a very difficult time.
Yeah.
So diversifying your supply chain away from China is probably not a bad idea. Now, in our case, we have a very clear perimeter that we're going after. We're going after North America primarily. Mm-hmm. When I say North America, I mean USA and a little bit of Canada, but mostly USA, not so much Mexico, and Western Europe, so France, Germany, Spain, so forth. That's really our perimeter, and that's about $800 billion between those two.
But there must be products that you expect to come through your distribution centers.
Oh, yeah.
Or sorts from all over the world.
There'll be some source from China, but you don't want to have a preponderance of your supply chain coming from China. That's highly risky.
Is that different to how you would have maybe done this kind of business previously? Like that newfound supply chain resiliency is at the back?
Absolutely. I mean, I gave the keynote at a big trade event out in California about, 8 or 9 years ago. And the topic was globalism. And I was a big champion for thinking globally, but the world's changed a lot in the last decade.
Yeah, you don't hear that much anymore.
No, you don't.
I have a question that I thought of earlier, and I don't want to forget to ask it. It's about warehouse tech. And we did this episode. It was actually about the snack food industry and why there are so many proliferations of snacks like, Korean prawn flavored Doritos and stuff like that. And the guy was saying that one of the technological breakthroughs is that with the robots in the warehouses, they can get a lot more SKUs within a given amount of square footage because they can pack the warehouses in different ways and have the robots go around and stuff like that. What do you see on that? Like over your years of dealing with warehouses, are you able to get is that the same in the various industries you work with, that a given amount of square footage can have a greater diversity of goods these days due to automation?
A warehouse managed well can be far more productive and efficient than one that's like a hardware store.
Yeah.
So slotting, for example, slotting means you use the data to analyze which SKUs tend to go out together. And you position those in the warehouse, you locate them next to each other. So you save a lot of time, for example. In everything, so warehouse should be in the warehouse of the future is less and less people.
Yeah.
And more collaborative robots and automation. If you go to some of the more advanced GXO warehouses and you look around and you go, hey, where's the people? It's very quiet here. Very efficient and very, very effective what it does. That's the future, for sure.
This is a question from the audience, but they're asking, because the industry is so fragmented and often, very regional, is there a part of the country that you're more focused on, at least initially?
No. National, we want to be national, we want to be global, but global in the sense of Western Europe and North America. We're not really pursuing the other parts of the world.
But like people talk, for example, about this great business migration to the southeast, the southwest, et cetera. But that's not at the level.
There's a lot of the growth rate for construction is certainly bigger down south.
Wait, here's something else I always wanted to ask a roll-upper to use.
A roll-upper.
What is it? What word should use?
An M&A professional.
Serial entrepreneur, billionaire, I suppose would work.
Well, don't call me a billionaire, but M&A professional. I like that.
Okay, M&A professional.
Thank you.
But okay, we know that you want to buy a bunch of companies. Does the sequence that you buy them in matter? Like, is the idea, okay, I buy this one, I buy that one, and then I put them together and I get to that level and then I do this and that? Or is it just like, we have all these targets, let's just try to complete as many deals as we
In
can?
the perfect world, which doesn't exist, yes, the sequence would be deliberate and you'd have lots of synergy between number one and number two and number three. In the real world, there should be some level of opportunism and seeing what's out there and what's actionable, what's a good value.
Since we're at a conference and it's the year 2024, I have to ask an AI question.
Great.
And I'm sure, everyone's doing something with AI, et cetera, and I'm sure it's all great and efficient. But what does that mean? And when when it's at this company or some of the other exos, what does it mean to you to put like AI into practice? And are there any specific areas where you could say, look, this is a tech that I want to call artificial intelligence, and it's either improved the product or significantly saved on cost?
So XPO was all about machine learning and AI.
Yeah.
When I first hired Mario Harek for my CIO, he's now CEO, but when he was CIO, the vision was, here's all these brokers, and they have like these halls with like hundreds of kids, and they're on 2 phones at a time, and they're playing. And we said, why do you need these people? This is stuff that should be done on an app. The shipper would prefer it would be better for the shipper to be doing it on an app. It'd be better for the dispatcher and the trucker to be doing it on an app. And why are you paying a third of your gross margin to sales reps when this is not adding, in some cases, enough value to justify that? And at that time, 0% of the business was automated. Today, RXO, the one that just bought Coyote from UPS, RXO is where we put the brokerage spin. 97% of the orders are either sourced or covered digitally. And I believe that is the main reason, not the only reason, but it's the main reason why RXO has been growing at 3 times the industry growth rate, because the model works better.
Are there specific pieces of technology or technology platforms that you can pull out of XPO or GXO and use for QXO? Like, do you use, for instance, like those trackable pallets? Those are very cool, I find. Could you use something like that for distribution?
So there's tons of stuff we could do with the XOs. We gotta be a little careful about that. That has to all be arm's length at the market and so forth. But yeah, there's tons of things that we could use from the XOs. You gotta remember, this business has a big component of transportation logistics. This is a business where you're transporting building materials from the OEM, from the manufacturer, by truck, mostly a little intermodal, but mostly truck, to the warehouse that you're managing, we were talking about before, and then you're delivering it in the last mile, generally to the job site, almost always by truck. So there's a big cost and a big efficiency and productivity and ability to delight or annoy the customer by getting transportation logistics just right.
Someone asked, and perfect dovetails with your answer there, how far up and down the supply chain do you go to ease bottlenecks? When you think, supply chain risk, I know supply chain professionals, this is what they've always done, but for the rest of us, supply chain risk is this new thing that most of us started talking about in the last 3 or 4 years, and I have to imagine it's going to stay on the minds of many business managers, particularly with the China risk and so forth. Talk to us about some of what you will do with QXO to hedge against that or protect against supply chain risk, and how close do you want to get to the producer? How close do you want to get to the end customer to ease those concerns?
I want to get very close. We want to buy directly from the manufacturer and want to sell directly to either the final end user or the contractor that's servicing it more often. Not so much the C, more the B that's serving the C, the business that's serving the consumer. So yeah, you want to be close. That's the whole business.
How do you do it?
The business plan is to buy in large quantities at a price that reflects, at a lower price that reflects those larger quantities and the risks you're taking by storing them and putting them in inventory, and selling them retail in smaller amounts at a price that is appropriate for retail. And that's your margin. That's how you make your business. But the supply chains, but you can't blame the manufacturer. You can't blame anybody on the supply chain but ourselves. If we're a distributor, that's our responsibility. Our responsibility is to get the supply chain right, to use technology and to use culture, to use compensation and recognition, to get people to take that seriously so that we always have the right amount of products in stock. So when customers want a product, we got it. And that when a customer needs it by a certain date, yes, we can do that. And if we do that, if a distributor does that professionally, I believe you'll get a little more price, not a huge amount more price, but you get a little bit more price, and you'll get greater share of wallet. That's my thesis.
I need treated plywood by this weekend, Brad.
I know a guy.
This is bad. Okay, there's one more question from the audience. And before I ask this one, I'm just going to give a plug to Brad's book, because it's all about his experience as an M&A professional. But it is one of the more unusual sort of entrepreneurial books that I've read, because you do have some unusual strategies in the way you think about business. So I remember there's a chapter where you talk about thought experiments to make you think in new ways. And one of the thought experiments was imagine yourself as a banana. That one sticks in my head.
I like that one.
But you also worked, and this actually led to another Odd Lots episode, but you've also worked with an ex-CIA official who was very instrumental in the use of lie detectors as someone to help you do due diligence on different companies.
And you interviewed him.
We did, and he was amazing. It's a good episode. But this brings me to the audience question. They ask, as you've applied various new and improved management techniques to your acquisitions, what are some old techniques that you found have to go or just aren't very useful anymore?
So my approach to business, as you can tell from reading the book, is really simple. It's very straightforward. You get great people. You figure out the big goals with great specificity and clarity. What are you trying to achieve? But bold. We're going to create a $50 billion company. I've got everyone in the organization completely signed up for that. And then you figure out, what do I have to do to get from here to get to there? What are the steps I have to do? And then who's going to be in charge of that? And then how do we tie compensation to that and how do we measure it, keep people accountable accurately, and appropriately and fairly reward people for achievement on that and keep people on track? That's my basic playbook. There's a lot of other details to it. That's my basic playbook. Great people, big vision, hold people accountable, and go make it happen. And as a result of that, you create, in all likelihood, great shareholder value.
The book's been out for several months. Has anyone, and it's called How to Make $1 Billion, right?
Few billion dollars.
Or How to Make a Few $billion.
Don't shortchange
So
me.
sometimes Tracy and I, because we've been doing the podcast for several years, like we'll get a email. It's like, by the way, I just want to say I listened to this episode. And then I went to business school, and now I got my first job on Wall Street. We've been doing it for a while. Has anyone called you up and said, Brad, I just want to thank you. I've made $1 billion since buying your book, or a few billion.
A few billion.
Not yet, but I underline the word yet. But I tell you what I have had. I've had a lot of people like what Tracy did, thought experiments.
I have imagined myself as a banana. It's true.
No, it's because the commonality of DNA between a banana and a human is quite significant. It's like 90-something%.
It is more than you would expect. I'll say that. Brad, there's another question I want to ask you, which is, you're an M&A professional, a serial entrepreneur.
Thank you.
You start one company that's very successful, then another that's very successful, and now another. How much runway do you give yourself for each company? And when do you declare, like, okay, I've done it here, and now I'm going to move on to the new thing, or now I feel prepared to take an additional thing on?
If you look at my bio, it's basically every decade. I really get into something, I started from scratch, this big idea, I get everyone, we do it, and 10 years later, we did it. And I do it again. That's my cycle. Everyone's got their biorhythm, that's mine. Once a decade.
Well, we'll have you back here in a decade, and you can tell us about your next venture.
Great. It'll have XO in it.
Sounds good. OXO. Do you have OXO? Oh, no, that's a company that makes...
That's taken.
Yeah, that's good. Brad Jacobs, QXO, thank you so much for coming on Odd Lots. It's an honor.